There is a number the financial system never shows you, not your salary, not your tax bracket, not your net worth, a different number. The number of people earning over $100,000 a year who still cannot figure out where their money goes at the end of every month. That number is 58%. More than half of every six-figure earner in the country is living paycheck to paycheck.
Not because they are irresponsible, not because they are bad with money, not because they did not work hard enough to get where they are, because the system they built their entire financial life around has a design flaw built into its foundation, and nobody, not their employer, not their accountant, not their financial advisor, is going to sit them down and explain it. Meet Jordan. Jordan is 34 years old. He earns $105,000 a year. On paper, he is doing exactly what he was told to do. He studied hard. He got the degree. He climbed the corporate ladder. He got the salary. And yet every month he stares at his bank account wondering the same question. Where did it all go? Now meet Priya. Priya is 36 years old. She earns $87,000 a year, $18,000 less than Jordan. And yet Priya is building real, compounding generational wealth every single month, while Jordan treads water.
Same city, same cost of living, different outcome. Today we are going to show you exactly why. We are going to break down the 4 invisible forces that are turning six-figure salaries into financial traps. And we are going to show you the exact moves Priya made that Jordan has not figured out yet. Stay with us,
because what we are about to show you will change the way you look at every paycheck you ever receive. Jordan remembers the exact moment he crossed 6 figures. He was sitting in his manager's office. The number appeared on a paper pushed across the desk, $105,000 per year. He called his parents that evening. His mother cried. His father said he was proud. Jordan went home and felt like the plan had worked. That was 2 years ago.
Today Jordan's monthly take-home after tax is $5,800. His rent is $2,200. His car payment is $480. His student loan is $310. His gym membership, streaming services and subscriptions add another $190. His groceries and food run $1,200.
His insurance payments are $340. That is $4,720 in fixed and semi-fixed costs before he has bought a coffee, taken a weekend trip, or replaced a broken appliance. He has $1,080 left over every month from a $105,000 salary, less than $13,000 a year in actual discretionary income, and somehow even that disappears. Last month Jordan's air conditioning unit stopped working. That was $900. The month before that his car needed new tyres. That was $620. The month before that his company had a leaving drinks event he felt he could not skip. That was $140 he had not planned for. Jordan is not reckless. He is not irresponsible. He is not buying designer clothes or taking luxury holidays. He is simply living inside a financial structure that was never designed to let him get ahead. Priya knows this feeling. She lived it for 4 years after university. Then she learned 4 things that changed everything. 4 invisible forces that drain six-figure earners without them ever realizing it is happening. The inflation illusion. The lifestyle ceiling. The tax cliff. The wealth gap. That is what we are covering today.
Here is what we are covering today. First, the inflation illusion. Why your salary grows in numbers but shrinks in reality, and why the gap between what you earn and what things cost is widening faster than any raise can close it. Second, the lifestyle ceiling. The silent automatic spending upgrade that follows every salary increase like a shadow, keeping your savings rate exactly where it always was. Third, the tax cliff. The specific moment where earning more money starts costing you more than the raise was ever worth, and how employees carry a tax burden that business owners legally never face. Fourth, the wealth gap. The fundamental difference between income and wealth, and why Jordan's $105,000 salary is making him comfortable while Pryor's $87,000 is making him rich.
Let us begin. Jordan got a raise last year, 8%, the best raise he had ever received. His salary went from $97,000 to $105,000. He celebrated. He deserved to celebrate. Then the inflation illusion hit. In the 12 months since Jordan's raise, here is what happened to his actual costs. His rent renewed. The landlord raised it by 11%.
That is an extra $220 a month, $2,640 a year. His grocery bill increased by 14%. That is an extra $168 a month. His car insurance renewed at a 9% increase, an extra $43 a month. His energy bills increased by 12%, another $60 a month.
Before Jordan bought a single extra thing, his 8% raise had been almost entirely consumed by inflation on his existing life. His real purchasing power, the actual amount of goods and services his income could buy, increased by less than 1%. He received a raise of $8,000 and gained the economic power of less than $800. This is the inflation illusion. Salaries grow in dollar terms. Real purchasing power barely moves. The gap between what you earn and what things cost compounds silently year after year.
In 1990, the average American needed to work for 22 weeks to pay for 1 year of their child's college education. Today they need to work for over 52 weeks. In 1990, a median home cost 2.9 times the median annual salary. Today that ratio is 5.8 times. The numbers on your payslip are growing. The purchasing power of those numbers is shrinking.
And the system is designed to make you focus on the number, not the reality. Jordan focuses on the number. Priya focuses on the reality. When Priya received her last raise 3 years ago, she did not upgrade her lifestyle to match it. She calculated exactly how much of the raise was real, after accounting for inflation on her existing costs, and treated only that portion as additional income. The rest she redirected immediately into assets before she ever had the chance to spend it. Jordan's raise made him feel richer for about 2 weeks. Priya's smaller raise made her genuinely wealthier for the rest of her life. The inflation illusion does not just affect what you spend, it affects what you save, it affects what you invest, it affects the decisions you make every single month about your financial future. And most six-figure earners never even know it is happening.
There is a psychological phenomenon that economists call lifestyle inflation. Most people call it keeping up with their own expectations. Here is how it works. When Jordan earned $75,000, he drove a used car, ate out twice a week, and lived in a 1-bedroom apartment with second-hand furniture. When Jordan's salary crossed $100,000, something invisible happened.
He did not make a conscious decision to spend more. He did not sit down and plan a lifestyle upgrade. It just happened. The used car was replaced with a leased vehicle. The twice-a-week restaurant visits became 5 times a week. The 1-bedroom became a 2-bedroom with proper furniture. The supermarket own brand products quietly became name brands. The economy flights became premium economy. Each individual upgrade felt completely reasonable for someone earning what Jordan now earns.
Together they consumed every single extra dollar the raise provided, and then some. This is the lifestyle ceiling. It is not a ceiling on how much you earn, it is a ceiling on how much you keep. The lifestyle ceiling is the automatic, unconscious, socially reinforced process of expanding your spending to match your income, keeping your actual wealth accumulation at exactly zero regardless of how much you earn. Studies from the National Bureau of Economic Research found that for every $1 increase in income, the average American increases their spending by 92 cents. 92 cents of every additional dollar earned is immediately consumed by lifestyle expansion. That leaves 8 cents per dollar of income growth going towards actual wealth building.
On Jordan's $8,000 raise, that is $640 per year in genuine wealth accumulation, less than the cost of one weekend trip. Priya understood this trap early. When her income increased 3 years ago, she made one non-negotiable rule. For every dollar of income increase, at least 50 cents goes directly into a wealth-building vehicle before it touches her lifestyle. She still upgraded her life. She is not living on rice and beans, but she built the upgrade intentionally with the other 50 cents, rather than letting lifestyle inflation consume everything automatically. The lifestyle ceiling affects six-figure earners more than anyone else, because at this income level, the social pressure to upgrade is enormous. Your colleagues have nicer cars, your peer group goes to better restaurants. The neighborhood you can now afford has a certain standard of living attached to it. Every social signal is telling you to spend your raise. Priya learned to ignore those signals. Jordan is still listening to them.
Jordan crossed into the 32% federal tax bracket when his salary hit $105,000. He knows this. His accountant mentioned it briefly during their annual meeting. What Jordan does not fully understand is what it actually means for the money he takes home versus the money he earns. Let us make this concrete. Jordan earns $105,000.
After federal income tax, state tax, Social Security, and Medicare, his actual take-home is approximately $69,800. He lost $35,200 to tax before he ever saw it. 33.5 cents of every dollar Jordan earns goes to the government before he can make a single decision about it. But here is the part of the tax cliff that most employees never fully confront. Employees are the most heavily taxed group of earners in the entire system, not the wealthy, not business owners, not investors, employees. Here is why. Jordan pays tax on his gross income before any personal expenses are deducted. His commuting costs, his work clothes, his home office, his professional development, none of this reduces his taxable income. A business owner operating in the same income bracket pays tax on profit, which is income after all legitimate business expenses have been deducted. The business owner's laptop is an expense. Their phone is an expense. Their home office is an expense. Their professional development is an expense. Their car, if used for business, is an expense. Every one of those deductions reduces the taxable income before the tax calculation even begins. Jordan has none of these deductions available to him as an employee. The result is that two people earning the same gross income can have dramatically different tax burdens depending purely on their employment structure. This is not a loophole. This is not tax evasion. This is how the system was designed. It was designed by people who understood that employees represent the most reliable and easiest group to tax, because the deduction happens before the money ever reaches them. Priya began to address the tax cliff 3 years ago. She started a small consulting arrangement alongside her employment, 2 clients, 12 hours a month, generating an additional $14,000 per year. That consulting income is structured correctly and taxed as business income after legitimate expenses. Her effective tax rate on that additional $14,000 is significantly lower than Jordan's effective rate on his equivalent income. She earns less than Jordan in employment. She keeps more than Jordan in total. The tax cliff is not about earning less to pay less tax. It is about understanding that the structure of how you earn matters as much as how much you earn.
There is a distinction that changes everything once you understand it. Income is what you earn. Wealth is what you keep, grow, and own. Jordan has high income. Jordan has almost no wealth. Priya has medium income. Priya is building significant wealth. Let us look at what this actually means in real numbers over time. Jordan earns $105,000.
After tax, lifestyle costs, and monthly expenses, he saves approximately $600 a month on a good month. That $600 sits in a savings account earning 2.1% interest. After 5 years, Jordan will have approximately $39,000 saved. In a city where the average house deposit is $120,000 and investment portfolios require meaningful capital to generate meaningful returns, $39,000 after 5 years on a six-figure salary is a quiet financial crisis.
Priya earns $87,000. After tax and core living costs, she directs $2,100 per month into wealth-building assets, not savings, assets. Index funds compounding at a historical average of 10% per year, a small real estate investment generating rental yield, the consulting income structured to retain more after tax.
After 5 years, Priya will have accumulated approximately $162,000 in investable assets, plus the compounding consulting income that has been growing its own client base. Same 5 years. Jordan has $39,000. Priya has $162,000. The difference is not income. The difference is not luck. The difference is not intelligence. The difference is that Priya understands the wealth gap. The wealth gap is the distance between your income and your net worth trajectory. Every month you can either close that gap by directing income into compounding assets or widen it by directing income into consumable spending. Jordan's $105,000 salary is making him comfortable. Comfortable is the enemy of wealthy. Comfortable means you have enough coming in to avoid the pain of financial pressure, but not enough going into assets to build real long-term security. Comfortable is the financial version of treading water. Priya is not comfortable. Priya is building. And the gap between comfortable and building compounds every single month. In 10 years at current trajectories, Jordan will have a higher salary than Priya, and a fraction of her net worth. The wealth gap is the most important financial concept that no employer, school, or financial institution has any incentive to explain to you. Because if every employee understood it, the system that depends on comfortable, high-earning, low-wealth workers would begin to change. So here is the move. Not next year. Tonight. Step 1. Calculate your real income. Not your salary, your actual take-home after all taxes. Then subtract every fixed and recurring cost. Whatever remains is your real discretionary income. Most six-figure earners are shocked by how small this number actually is. Step 2. Identify your wealth gap.
How much of that discretionary income is going into compounding assets versus consumable spending? If the answer is less than 30%, you are treading water regardless of your salary. Step 3. Find the one lifestyle ceiling cut, not 10 changes. 1. The single recurring expense that delivers the least value relative to its cost. Cancel it, reduce it, or renegotiate it.
Redirect that exact amount into an index fund or equivalent compounding asset immediately. Step 4. Calculate your tax cliff exposure. Is there a skill you have, a capability your employer already pays you for, that you could offer to 2 or 3 external clients for 10 to 15 hours a month? That income, structured correctly, carries a fundamentally different tax treatment than your salary. Step 5. Name your wealth number, the exact amount of invested assets that, at a 4% annual withdrawal rate, would cover your monthly expenses permanently. That number is your financial freedom target. Write it down. It makes the abstract concrete. Jordan has never done any of these 5 steps. Priya did them on a Sunday afternoon 3 years ago. That Sunday afternoon is the reason they are in completely different financial positions today, despite similar salaries and identical opportunities. Nobody told Jordan that a 6-figure salary could be a trap. Nobody explained the inflation illusion to him when he was negotiating his raise. Nobody sat him down and showed him the lifestyle ceiling before it consumed his income. Nobody calculated his tax cliff exposure and showed him what the same income could look like in a different structure. Nobody handed him the wealth gap calculation and showed him what $39,000 versus $162,000 looks like after 5 years of the same salary. The system was not designed to explain itself. It was designed to keep running. You stop today. You ask the question, And now you have 4 names for 4 forces that have been operating silently on your income from the moment you started earning. The inflation illusion, the lifestyle ceiling, the tax cliff, the wealth gap. Naming them does not fix them overnight. But you cannot fix what you cannot see. And now you can see them.
Tonight, do the 5 steps. Calculate your real income. Identify your wealth gap. Find the one lifestyle ceiling cut. Assess your tax cliff. Name your wealth number. That is where it starts.
Drop your wealth number in the comments below. The exact amount that would make you financially free. I read every single one. If this video changed how you see your salary, subscribe right now. Because next week we are going to show you the exact reason your savings account is working against you and what to put your money into instead. Subscribe, and I will see you there.